There is another way to get ahead. I know plenty of people right now that are investing into short-term projects using their self-managed super fund to basically become a money partner on flip projects.
This is the downside of these changes. When you make reckless policy that impacts a sound and safe investment platform, what happens is you start seeing panic advice. God, he gives me PTSD.
The rules that limit borrowing.
As my daughter would say, thank you, Jim. Thank you for being a training exercise in how to work around idiocy.
We're trying to delete residential investment properties as an investment class. So I'm really not surprised by this one iota.
Here's the funny thing with it. The principles of residential property investment haven't changed. What has changed is some people getting in the middle of it to change the rules in which it can be engaged with. What a week it's been. We've grappled with the budget recently. I'm not going to get into the whole trash talk of the Labor Party and all of that. There's plenty of people out there that will do that. I'm more focused on how this impacts our profession. And then, of course, in the recent week, we've had Chalmers and Co. with the Greens announce some changes to SMSF lending, meaning that we can no longer borrow money in an SMSF for residential investment. So I want to just jump onto some of the social media that's been out there and let's check it out.
Old way of buying residential properties inside of a self-managed super fund, they're gone. You can still buy commercial property inside of an SMSF and still get the same borrowing and still take advantage of obviously the capital gains tax concessions that you get in super. But for residential property, it's no longer the same. It does not mean though, you can't buy residential property inside of an SMSF. You just have to do it differently, using a company structure or potentially a unit trust, investing funds from your superannuation into those entities and then buying property in those entities is still possible. Getting lending in those entities is still possible. There are naturally rules and regulations that you have to follow by. So getting the right advice is very critical. But what is becoming more and more...
Okay, I'm just going to cut it there because he starts jumping into the politics of it. Look, he's not wrong. This has changed. And what's it been for brokers? There are brokers who specialise just in residential SMSF. But as with any aspect of life, just like with AI and the way it impacts certain occupations, this just changes things a little bit. We just have to readjust and we have to reassess, re-strategise. He's spot on. Limited recourse loans in super funds for residential borrowing is gone, or it is going. But it doesn't mean that the opportunities aren't there. If I was a broker doing it, I'd be looking at, okay, you've still got a pool of customers who have got residential lending arrangements, and there will still be lenders that will exist to provide the best possible pricing in the market for those customers. So there's still refinance opportunities. There's still commercial opportunities. And as he touched on just before, there's other ways to get into it. For example, purchasing through a non-individual entity and the super fund potentially holding some shares in it. It may not be exactly what it was originally, but if the opportunity warrants it, there should be strong and prudent advice from brokers who can exist to empower their clients so that they too can pivot with these changing times. So let's go on to the next one.
SMSF's borrowing money to buy residential property is about to be scrapped. This budget just keeps getting more and more interesting. The government has just caved to the Greens, I guess, to ban when the legislation passes the Senate, hopefully next week is what everyone's suggesting. There will be a ban on SMSF's borrowing money to buy residential property, so-called LRBAs, as everyone's done for many, many years. Commercial property will still be okay, but SMSF's borrowing money for residential property will be banned. Anyone that's already got an arrangement.
Okay, again, same thing. I like his seeing it more as a challenge than a gripe. No doubt he's still frustrated for his clients. Again, we've all got clients who have been caught, who have had plans to actually purchase. But here's the thing. Even though non-recourse lending going forward is going, The legislation and the timing of the implementations is still unknown. It will be grandfathered, and it does mean that there's other opportunities to mitigate. Again, commercial property, always an option. It's unclear whether the off the plan will be available. I dare say no, but you never know with it. Who knows with the Greens, eh? I think the key thing with it is brokers, those of you who are specialising in this space, those of you who have clients who are actually needing advice in this, be a source of knowledge and be a source of refuge with your advice to your clients so that they can feel some strength and empowerment. On an individual level, even if you are feeling frustrated with it, as we all are, we can still mitigate. Here's the next one.
And so the changes that we've agreed today will strengthen the rules that limit borrowing by superannuation funds. We will ban these arrangements for residential property going forward, but we will leave the existing arrangements in place for those existing investments and also have a 45-day transition period for any investments which are currently midstream.
As my daughter would say, I'm going to do something different. Thank you, Jim. Thank you for being a training exercise in how to work around idiocy. Now, we understand the politics of it. Unfortunately, the bubble of Canberra, we all don't work in that. But we do have ambition, we have strategy, we have intellect on our side. So the key thing is with these changes is this. Those that still want to work in this space, there is a good proportion of the population who have residential investment property in their super fund. Okay, politically, Jim just said, oh, it's only 1%. So my question to you as a broker is this. Would you be happy if you had 1% of the population as your client base? Still a lot. So become the expert in this space. Become the expert for those people who are simply going to be grandfathered. Grandfathering can have several meanings. It can mean it stays as is, but it also means it can get neglected. People forget about it. People move on, sadly. So don't forget about them. That is a class of clients that actually need support. Become the expert in that space, and all of a sudden you've turned a political backroom deal into your next business niche. Shall we do one more?
They're trying to delete residential investment properties as an investment class. So I'm really not surprised by this one iota. Firstly, I'm not surprised by the SMSF changes. Okay, why? Because they're trying to remove residential property as an investment class altogether. Going back to Scott O'Neill, who, predicted this so well, residential property is, a political asset, you'd say, because, people...
I'm going to fast forward through this a little bit.
Investable asset class. The problem which I'm constantly communicating to people is this. People invest in residential property because you cannot put your money in the bank, which I've explained, okay? Because of inflation, you go backwards after tax every year if you put your money in the bank, okay? So people have to hunt down another avenue as a store of wealth. Now, the reason why residential property was selected by the greater public is because it's easy to understand and people aren't finance experts. So now that they removed it, it'll be very interesting to see what direction people go in order to protect their purchasing power, because as we know, can't do it in the bank.
Okay, so here's the funny thing with it. The principles of residential property investment haven't changed. What has changed is some people getting in the middle of it to change the rules in which it can be engaged with. I'm not going to make this about investment advice. That's not my swim lane. But what I will say is this. Residential property, real estate in general, has survived every economic change in the Australian economy since records have been kept. That's been replicated globally. So the reality is, doesn't matter if it was through the Great Depressions, recessions, the GFC, and now Chalmers, the reality is that the substance of bricks and mortar is still there, even if the returns may have diminished somewhat. Doesn't mean that we start to move straight out from residential property into something else. I'm not giving advice either way. But from a broker perspective, doesn't mean we should just abandon this and go, oh, well, it's a shit show, it's done. No. In fact, this is the opportunity to really educate and empower. Don't get caught up in all the hype and the emotion and the energy. Look at it with logic and intelligent eyes and look at how you can add value. For example, residential property is still AI-proof. People will always need somewhere to live. So supply and demand suggests that the more people that exit means rent goes up. We've seen it in Victoria. So, for example, educate your clients. Talk to them about the ups and the downs of it. Obviously, they need to get independent financial advice with these things. But providing these alternate perspectives means instead of it just being a pile-on of commentary about how, whoa, 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 this is so bad, look at how we can make the best out of it. How can you turn mud into chocolate? What else does it mean? It means potentially looking at well-built, high-growth suburbs where populations will want to gravitate. Become the experts is my common theme to this. The road must always be travelled, even if there is an idiot standing in the middle of it. Work your way around it. If you do that, you'll have a business that is both successful and long-term. Have we got time for one more?
Since these absolute fucking muppets that are in government right now have scrapped being able to buy a property in your self-managed super fund to try and get ahead for the everyday Australian, there is another way to get ahead. I know plenty of people right now that are investing into short-term projects using their self-managed super fund to basically become a money partner on flip projects. There is a number of people in my community and a number of people that I've worked with on my own projects that have helped fund my own projects that can get a minimum 15% per annum return on their cash inside a self-managed super fund. Now, this is obviously not...
Sorry. This is the downside of these changes. When you make reckless policy that impacts a sound and safe investment platform, an investment class that helps a great portion of the population finding properties and finding somewhere to live and providing that shelter. When you make that, when you put that onto the fringe, then what happens is you start seeing panic advice, investing into flip properties, 15%. The opportunities that are there, by no means are they comparable in terms of the risk class. And I would advocate to anyone that they get sound advice from their finance advisor and their broker, being you. Because at the end of the day, short-term flip properties, yep, sounds good. You also got a 5 in 6 chance of surviving Russian roulette. This is where mortgage brokers can take a leadership role. Be the light that steers your clients away from panicked and rushed investment decisions. Provide them with the education, the knowledge, and the tools to be able to make sound decisions to navigate these difficult times, and you'll come out as a hero every time. That's a wrap for me. Just my opinion only, not financial advice. There's a link below. If you want to have a chat, reach out. Bye for now.